Happy Friday, traders. Well, we have made it to the end of the week. Okay, so looking back on this week, the most important thing that happened this week and set the tone for trading in markets, and probably has set the tone for trading for some time, was obviously the US CPI number that came out on Tuesday. So look, headline CPI and core CPI being just a touch below 3%, a touch above 3%. Market looked at that as being very friendly. Market obviously was a little bit scared that maybe we'd start to get a bit of tariff effect and a spike in inflation. Did not happen. So the big news this week is the market getting very excited and pricing in Fed rate cuts. And post that CPI data, the market was priced in so far, 63 basis points, so just a little over 2 rate cuts for the Fed by the end of the year. And risk absolutely loves rate cuts, so risk does what risk has been doing very well for quite some time now. We've seen equities, new record highs almost on a daily basis, S&P, NASDAQ. And we also saw Bitcoin join the risk party and make a new record high at $124,500 US yesterday. So yes, the tone of trading certainly has been very risk on bullish markets. But look, last night we did get some more US economic data, some more inflation data in the form of producer price index, so the PPI numbers for July. And normally this is not a print that moves the market too much, but this one did shock the market. So year on year, PPI for July was supposed to come in at around about 2.5%. That came out well above expectations to a whopping 3.3%. So that was the biggest and the increase that we've seen in PPI since 2022, so 3 years. The month-on-month number, PPI went up almost 1% at 0.9%. So huge increase in the producer price index. And so look, what it is basically saying is that the tariff effect at the moment is that the producers at the wholesale level have been eating the cost of the tariffs. Now look, at some stage when obviously profit margin starts to decrease for producers, no doubt what they will do is then pass that cost increase to the consumer. And then obviously it's going to start to show up in CPI. So it's just obviously a timing issue and a question of when, but no doubt the next few months, and especially starting September, CPI and PPI numbers are going to be very important. But in any case, the market, look, they did trim the Fed rate cut bets from that 63 basis points from CPI down to 58 basis points. So the market still is okay with a couple of rate cuts, even though with that punchy PPI number. So that was a bit of a surprise. US bond yields, which have been absolutely smashed since that poor labour market data, did actually rally on the back of that PPI number. So US 2-year yields were up about 10 basis points, and so was 10-year yields as well, up around 10 basis points, and they're pushing back to 4.3%. In any case, yes, then the US dollar had a very good rally on the back of this PPI data. Equities initially did get hit, but of course by the dip, buyers were there and stopped any sort of serious sell-off in the equity space. But look, moving forward, today the data rolls on. We've still got one more US data print before the week ends. That is US retail sales data. Look, US retail sales is always an important print for the simple fact that it is a health check on the consumer, and the consumer is the backbone of the US economy. It's a consumer-led economy. And also this number is going to take a bit of significance and focus as well, just for the simple fact that post the bad revisions on the non-farm payrolls and the employment number, the market is certainly going to be seeing is whether or not that will feed into a weaker consumer. In any case, look, the month-on-month number, the market's looking for a positive number of 0.5%. So if obviously that number comes in sub 0.5% or even goes negative, then the market obviously will think that that labour market, the consumer is a bit weaker, and start getting more confident again for the rate cut bets. But if we do see a number that comes above expectations and surprises, no doubt maybe the thinking of aggressive rate cuts will be pared back a touch. So look, important tonight, no doubt. And again, we will probably see some good swings in the currency market on the back of that. So watch what happens with bond yields on the back of this data. If those bond yields do go up, then just buy USD against anything. It should work. Okay, now just before you go into the weekend, it's probably a good idea just to be aware that you have got some decent gap risk happening this weekend. And that gap risk will come from the meeting between Putin and Trump. That's in Alaska, which is happening after the market closes. So look, the markets that could get impacted there are obviously commodity markets, crude, number one. Trump has actually come out pre-meeting saying that he thinks he can do a deal with Putin. He always says he can do a deal, so that's probably no surprise. But if we do see positive headlines and the market starts thinking that Russian sanctions may be lifted, we're going to see a lot more Russian crude on the market, which will increase supply, which will decrease price. So crude could potentially gap lower on Monday, depending if we get those positive headlines. And then also on the back of the positive headlines, if we're moving towards ending the war and market starts wanting to price that in, gold being a safe haven, which was bought aggressively due to all these war concerns, could gap lower as well. Gold certainly has been trading lower in the last session as well, on the back of that PPI, a strong number, yes, and a stronger USD, but also going into the weekend, traders obviously are getting rid of some of their gold longs, or trimming them at least. And then also, no doubt, Euro as well. It could be a positive for Euro, gapping higher, obviously because the war is in Europe, and better times ahead there. So yes, there could be potentially some risk positive headlines coming, and risk gap on Monday. So something to be aware of into the close. Good luck for the end of the week, and we'll catch back in with you next week.